Hey guys, Nate here with NuView Trust Company, and today we're going to talk about 5 considerations you should make before buying real estate in your self-directed IRA. Number 1, first consideration, taking title. How are you going to take title to the property you intend to own within your self-directed IRA? Whether that's a self-directed traditional, a self-directed Roth, a SEP, how are you going to take title to that property? Ultimately, for us, a self-directed IRA custodian, we can't tell you how you should do it. Some clients, if they're just buying one rental property, one fix and flip, they may just take title to that property in the name of their IRA, and we can process that perfectly fine. But there's other considerations to make. Maybe you want to set up an LLC. Maybe the LLC takes title to the property and the owners of the LLC are your IRAs. We can do it that way. You can also use a trust. You can use any type of entity out there, but it's ultimately your decision on how to do that. Now, obviously, entities take up a little bit of extra cost in some case, but ultimately it depends on you, and it depends also on the type of real estate you buy. Single family residence, pretty safe, but if you're going to invest in things like multifamily or commercial property, then an entity might make more sense, but check with an entity specialist before entering into any type of investment. Number 2, who's going to manage it? So with an investment property in your IRA, you have to be careful about how active you are in that investment. As the IRA owner, as the fiduciary of that IRA, you have to stay at an arm's length from the investment, meaning you can't do the rehab yourself, you can't actively manage it, but you can pick the renters that live in that house. You can pick the contractors that work on that house. But if you've got a lot of investments in your IRA that are real estate related, you might be better suited to have a property manager handle the rents, collect the rents, pay the expenses, and then whatever's left over, they can send that back to NuView, and that can be deposited into your IRAs as net profit. So again, we don't care which way you do it. You can have renters pay rent to your NuView account and it goes right in, tax deferred or tax free, or use a property manager. Number 3, capital. How much capital do you have in your IRAs? The cool thing about IRAs or self-directed IRAs is you can partner accounts together. That's something I like to do. So for instance, let's say you and your spouse each have Roth IRAs. You might have a SEP IRA or a 401k because you're self-employed. You might have an HSA or a health savings account. You might even have education savings accounts set up for your kids or your grandkids. All of those accounts can partner together and buy a piece of real estate. Now, the important part to remember is that when you have multiple accounts partnered together, you have to pay expenses and collect income pro rata, meaning each account has its own percentage of ownership, and you have to stick to those percentages when you pay things and collect things. Number 4, non-recourse lending. Now, non-recourse lending can help you with consideration number 3. Where's the capital coming from? Non-recourse loans are great to add capital to your IRA so that you can buy more investments or have a little cash sitting there in case of emergencies. But remember, with non-recourse loans to your IRAs, you do have to factor in unrelated debt finance income tax. It's not something to be scared of, just something to be aware of. And there's a lot of different solutions as to how to minimize that unrelated debt finance income tax, or in some cases, eliminate it completely. And number 5, the last consideration is RMDs. Remember, required minimum distributions play a part in retirement accounts, especially if it's pre-tax, like a traditional IRA. At age 72, you're expected to take distributions in retirement, and you're no longer allowed to make contributions. This could affect the assets that you hold within a traditional IRA if it's real estate. Because remember, taking an RMD is a little bit different when you have a house that's your asset. It's not like you can take the porch as your distribution, so you've got to take cash as a distribution. Here's the cool thing though. If you have multiple IRAs, say some at NuView that hold real estate, and you've got some Fidelity IRAs, you could take or satisfy your RMD from any custodian as long as it satisfies all the RMDs that you have. So oftentimes it's easy to just sell stock at Fidelity, take your RMD there that satisfies both accounts, and you can keep the real estate in your NuView account growing tax deferred or tax free. I hope this helped gain a little bit of an understanding of what you should consider before buying real estate in an IRA or a self-directed IRA here at NuView. If you have questions, reach out to us at info@nuviewtrust.com. I'll also have our phone number in the description there. And remember to follow us on Facebook, get live notifications for when we go live, subscribe to our YouTube channel, and check out our website, www.nuviewtrust.com.